Hi, and welcome to our brief tutorial on why we should be investing in real estate. This is presented to you by InLaw Investments. To get an accurate picture of why we should be investing in real estate, which myself and other principals here at our firm over the years have done pretty consistently, the best answer for us is to go ahead and take a look at the long-term and short-term performance of the more traditional investment tools such as IRAs, RRSPs, mutual funds, bonds, certificates of deposits, all of these items which provide extremely low returns. So let's go ahead and take a peek at two of the more traditional investment tools and investment products that people use for their retirement savings, and that is the 5-year CD or certificate of deposit and the 5-year on-the-run U.S. Treasury bonds. We're going to look at the gamut basically from 2000 and 2011. In 2000, we were at 0.27% return, and we saw that go up. That was apparently a fairly decent return for a lot of investors, so there was a lot of activity on these markets in 2001 and 2002, but we're going to start seeing a decrease in 2003, 4, 5, and finally where it bottomed out in 2006. This was due to the fact that there were such high returns in real estate at this point in time that people were pulling all of their money out of these traditional investment tools and they were reinvesting it in real estate instead. But why do we see a jump from 2006 to 2007? Because in 2006 was when the financial markets and the credit crisis had occurred, and with the devaluation of real estate, people got very nervous and again pulled their money out of real estate. And in the big years, 2006, 7, and 8, we see a dramatic increase where people's money was reinvested into these more traditional investment tools, where it topped out in 2008 at 1.02. We started to level out in 2009, 10, and 11. We've started from 2010 to 2011. We've started to see a decrease, but let's take a little bit closer look at the CDs now. So now that we're looking at our most recent activity from December of 2008 until just a couple months ago here in December 2013, what we've seen is we've seen even these investment tools start to take a dramatic downturn. Right now on your typical CD, 36-month, right now you're getting about a 0.5% return. What that basically equates to on a 5-year CD is at 0.5 over the course of 5 years, there's a $1,250 return. At 0.2, which is where most of these are starting to hover now, over 5 years, that's a $500 return. And that is on a $5,000 investment. So truly the returns on these are quite dismal. The reality, the true stark reality in looking at these traditional investment tools is traditional investments like our IRAs, RRSPs, mutual funds, bonds, and CDs, not only do they provide extremely low returns, but the financial institutions and the banks that have been offering these investment tools have been sporadic and very unpredictable since before the credit meltdown, and even more so now that we're post-meltdown. So let's even take a closer look at the markets in general, spanning from 2002 until mid-2012. In 2002, shortly in there was tremendous amount of investment into the tech markets primarily. We had companies ranging from anything from selling widgets to eBay with online auctions. And none of these companies had even produced any profit and loss statements. So there were a few companies like Amazon, eBay, and a handful of others that were actually quite profitable, but the majority of these, without ever producing a profit and loss statement, were nothing more than phantoms, ghosts, dreams, and just a very weak semblance of reality. Once that really started to take hold of the markets and sink into investors' minds, we saw a dramatic decrease. And of course, we had our same sporadic highs and lows from 2003 all the way through 2008. Again, 2008 was when a lot of money went into the stock markets following the following the housing boom. And what we see is that we saw it take from 2008 until mid of 2009, when the banking crisis and the credit crisis hit, took a significant drop, lower than any time since the Great Depression. Then we started to go ahead and inch back up, and in 2012 we're not looking too bad. However, there's still that up and down curve here, which makes me, and probably makes most investors, very, very skittish. And let's take a real close look at who really benefits from investments on the stock market. Now here's another investment tool that traditionally a lot of retail investors like you and I have lost money, and that's in the stock markets. The very, very tricky thing to get a firm grasp on. But the reality is, if we're going to look towards the left of this little chart, when it's at the bottom, this is typically when buying begins. This is usually a result of an IPO or initial public offering. What causes those stocks to come up is that your inside trading firms, your folks on Wall Street, private equity firms, the big investment houses with the inside information that are better educated than folks like you or I, this is when they start to buy the stock. And when they start to buy that stock at the bottom and it starts to go up, that's when they're in a really good meaty part of the curve. And that's really when we start to hear about it. Sometimes our friend buys the stock and they make money. Then it makes the cover of Time magazine, and this is what we like to refer to as the period of exuberance. Everything looks great, the sun is shining. That's when we buy the stock, and it continues to go up for a little bit. When we look at the top of that bell curve, what goes up has got to come down, folks. And when that stock price starts to come down, and we're still a little to good, we've still made a little bit of money, we're hoping that it's just temporary. But as it makes a rapid drop, what we find is, we find that we're under what we paid for it, we're below cost, and we can't sell it now. And it continues to go down, and we're praying that it's got to come back, and eventually we sell the stock in disgust and we lose money. And when we've dumped all of our shares back into the market and have taken a bath, that's when the same investment firms and private traders and the equity firms, that's when they come in and buy that devalued stock back. And when it readjusts upwards, they make a lot of money, and folks like us end up taking a bath. And it's at this point we need to take a very close and realistic look at who's making money on investments. We've already covered that traditional investment tools, they provide terrible returns. We know that the banks and financial institutions, they're sporadic at best. And those stock markets can only go so high, and it always ends in an eventual downturn, which benefits the institutional folks, the institutional investors, but it hurts folks like you and I. So what would provide a more reliable and historically predictable return on investment other than those traditional methods that we've detailed above? The hard truth and the reality of investment money, folks, is this. Banks are in business to make the banks money. So when you've got $5,000 or $10,000 or $100,000 parked at your bank on a traditional CD, when you've got your money tied up in mutual funds, municipal bonds, whatever the case may be, their job is to make them money using your money. They loan it out at 6%, they take 5.5%, and the resulting 0.5%, that's what the folks that are investing the money in the bank take home. Again, stockbrokers' jobs are to make their firms money, and banks' jobs are to make banks money. So that leads us to one simple question: how do I become my own bank? How do I take control for my own returns and be able to find myself a more consistent, higher return than what I've been getting in the past. So that brings us to the big question: why should I invest in real estate? And let's take a quick peek back through the years and maybe get a better understanding. It's during the boom years of 99 through 2006. That's when real estate went on the same high and low roller coaster ride that the traditional markets, including the stock market, that they experienced. So when we take a look at the Standard & Poor's Case-Shiller 20-City Home Price Index from 2007 until 2014, we're looking at a period from 2007 to 2006 when real estate went on the same crazy roller coaster ride that all the other financial markets went on. And when it got up there to that pinnacle in 2006, we see a little downward curve and a little up, kind of fluctuated a little bit, leveled out. That's when there was unsurety about the markets. But when that credit collapse happened, when the inexhaustible amount of credit that people were able to borrow, when the ridiculous ability to borrow 120% of the equity into your home, when that big boom came to an end and when the bubble burst, we took a big drop from 2009 or 2008 all the way through to 2010. But since this time, what we've seen is that we've started to get a little bit more well adjusted. We went up a little bit, we went down a little bit, we're on an upward curve. But basically, we have settled right in the middle part of that graph, which is the most comfortable place for us as investors to be. More predictable, more secure. So having covered that during the boom years when real estate went on the same high and low roller coaster ride that the other markets had went through, what we were really excited about is though most markets went haywire and have yet to adjust, the average housing price index, or what is going to be referred in future videos as the HPI, that has leveled out to pre-recession values. And a great illustration of this to substantiate the true inherent value in real estate investments, we're going to take a look at the Federal Housing Price Agency, HPI, as provided by the Federal Housing Finance Agency. And we're going to look right along the middle of that. We have a line. The blue lines are the month-to-month changes in percentage. And we're going to see from 2000 until 2006 when the big bubble happened and all the markets collapsed. Month to month, it saw fairly consistent gains. It may have dropped a little bit, but for the most part, we stayed on the upper side of the scale. From 2006 up through 2007, 8, 9, 10, 11, what we've seen is the down market. However, this is a nationwide total, but even on a nationwide total, post-recession here in 2012, we're looking at better than 5% above the median. So in other words, real estate has readjusted. It has not gone on the same crazy up and down roller coaster ride that all the rest of the markets have taken. And this is a perfect illustration that the HPI has adjusted to pre-recession levels. And if anyone is still struggling with the concept of what's a safe place to invest and why to invest in real estate, let's just make it real simple. From January 2013 to March 2013, a little better than 13 years, the Dow has provided over those 13 years on average 28.8% positive returns. Standard & Poor's, much less, 8.9%. And the most unpredictable and volatile of all the markets, the NASDAQ, is almost 20% loss. And above and beyond all of these investment tools and the little measly 0.5, 0.02 returns that we've been looking at for CDs and treasury bonds, real estate over 13 years has provided a 46% return on investment. And most investors, after watching a little measly half return on their IRAs or on their certificates of deposit, they understand that real estate can never go to zero or near zero. It always maintains its intrinsic value. The next thing, very important, there was always a hard asset. When you own a piece of real estate, you have the ability to pull up in front of the house, stand in your driveway, and see your house. The dissolution of companies, the failure of markets, crashes in pricing will never make the value of a real estate asset decline to drastic lows or become worthless. But there's a couple other real good points about real estate. If we look at the third bullet point, you cannot draw equity out of stocks, you cannot draw equity out of IRAs, etc. without liquidating. And most importantly, when you have multiple properties in a portfolio, it allows you more flexibility from a liquidity standpoint. And a very important aspect to look at when you're thinking about buying real estate is that the key to successfully purchasing investment property solely for the purpose of generating income is in captured equity. And we're going to take a close look at exactly what that is. And to explain captured equity is buying real estate assets below market value. And how are we going to substantiate market value? Now, we've heard of the traditional tools like Zillow and Trulia, Realtor.com, cyber homes. There's a dozen of them out there. However, they're not updated. What they may show as a sale price for a property might not actually be the amount that a homeowner or an investor bought the property for, but the amount that the bank took it to the courthouse steps to foreclose it on. What comps are, good comps compare apples to apples, and that is comparing your asset with similar quality assets with equal or less square footage in the same subdivision or within 1/4 mile of the target property. There are some realtors out there that will try to pull a comp from a mile away or from a mile and a half away. That is not comparing apples to apples. A 1/4 mile is a safe bet. Anything over that, you are probably in a different quality of area, either higher or lower. So we like to be within a 1/4 mile of the target property. And the only true valuation of a property and the only numbers that mean anything is the MLS. And what that is, that's the multiple listing service. And that is the data nationwide that realtors have access to. And that captured equity, very last, allows investors to go liquid on individual assets if the need ever arises and know at the very least they're going to get their money back. So to sum it up, why should I invest in real estate? Well, number one, I want to make the same return on assets that banks would typically find appealing. If a bank is making mortgage loans out at 4, 5, 6, 7, 8, 9, 10%, I'd like to make those same kind of returns myself, so that my investment product will never be worth zero, like stocks and CDs and municipal bonds. You may still have the same $5,000 at the bank, but you're only getting 0.02% return on that. Next, so that I am not a puppet of brokers, counselors, or banking representatives. We've already covered the fact bankers are there to make money for the bank. Us as depositors are a secondary consideration. They pay us as little as they think we are willing to accept to keep our money in that bank. And most importantly, so that if I ever need to, Lord knows nobody wants to run into any financial emergencies, but so that I can go liquid and get the initial amount of my investment back. If I'm getting 9, 10, 11, 12% returns, and I can get the same money at the house the same way I'd pull the money out of my CD, but I get a higher return, most likely real estate is the way that I would go. And here are just two real cookie cutter examples. The property on the left, comps on that property are in the 110 range. That property sold for $82,000. That's captured equity of over $20,000. The property on the right, neighborhood comps, $120,000. Sold for $90,000. The house on the left, beautiful, gorgeous countertops, granite, refinished hardwoods. The one on the right, new roof, now exterior, new paint. Both of these houses taken all the way to the nines. They support that top comparable value of $110,000 and $120,000. There's captured equity there, and my return on investment annually is between 11 and 15%. And here's a couple of perfect examples about captured equity and about holding investment properties. The one on the left, comps in the neighborhood, $110,000. This property sold for $82,000. That's captured equity. The property on the right, these are actual properties that have been in inventory. The comps on this one were in the $120,000 range. Now bear in mind, these houses were absolutely rehabbed to the fullest extent, like all of our properties are. The comps are at $120,000, we sold it for $90,000. That means if I buy either one of these houses for $82,000 or $90,000, and a couple of years from now I want to get out, I'll probably get my $82,000 or my $90,000 back out of it. We're capturing equity, and these properties are returning an 11% to 15% return on investment. And if you have decided that you're ready to take control of your own financial returns and your own investment and your own retirement, and would like to get involved with income producing real estate, please contact Sean at InLawInvestments.com. Thanks for watching.